And there is an exciting component to this as well from a institutional perspective, from the kind of traditional finance perspective. There is a time to market aspect.
The intent side, you're seeing a lot of like bridges being built between permissioned and permissionless. And, I think the devil will be in the details of like, what does it mean? What is required to move from a permissioned to a permissionless system and vice versa?
I don't think like when institutions are coming over there, like lack of privacy is going to be support them. So we do need a proper layer on top of existing blockchains.
As you get more centralization and everyone's piling into the same yield, that concentration creates a lot more risk.
How should we think about these institutions integrating into our system? How important is it that they use an open permissionless chain?
What does this idea of neo-finance as the evolution of DeFi mean to you? How do you think about this next set of applications and user experiences?
Welcome back to The Rollup. I'm Robbie.
I'm Andy. Robbie and I met at the University of Florida in 2017, where we first found out about digital assets.
We learned a lot along the way, and we're bringing you face to face with the leaders of our industry.
Sit back, relax, and enjoy today's episode. Ladies and gentlemen, welcome to the show. Guys, good to have you on. Royal, Kendall, Alex, Rishabh, welcome to the show.
No ladies on this one. I think it's just Pepes and gentlemen. So
Great to be here for having us.
Great to be here.
Thanks for being here, guys. We just had a great panel with apps and intents. We had CowSwap, we had Near Intents, ThorSwap, and Socket up there, and we were kind of describing this multi-chain landscape. As you heard Andy and I talking before you guys jumped on, we're also unpacking this neo-finance landscape, which we believe is this convergence point. It's the evolution of both the legacy financial banking world as well as kind of the old guard DeFi world, which some of it's found product market fit, but a lot of it hasn't. So that's kind of where we'd like to start, is in a multi-chain world, in this like new maturation of teams and projects where we're kind of forced to find product market fit. I'm curious about, what you guys think sticks around and what you guys think is left behind. And so, maybe that's where we'll start, but we'll also get a quick intro. I think, why don't we start with Royal and we'll go around the horn. Feel free, quick intro about yourself. And then, tell us what you think stays behind, gets left behind, and what you think sticks around in this new era of DeFi.
All right. Hey, thanks for having me on, guys. I'm the Royal Fool. I'm the co-founder of Templar Protocol, which allows you to borrow against Bitcoin or any asset on any chain without trusting centralized intermediaries. To answer your question about what's sticking and what gets left behind here, I still think that we are very, very early as far as transitioning the entire financial system onto crypto rails. And I believe that ideologically, there is a place both for kind of like cypherpunk, decentralized finance that was like the original spirit in which Bitcoin was built. And Zcash is really kind of resurged under that banner as well. In addition to, there's like an undeniable like tidal wave of assets that are coming on chain, both in the US and internationally. So I think there's going to be a place for both. So I don't think it's necessarily but my focus isn't like on what quite stays and what gets left behind so much as it is where are the biggest opportunities. And I think some of the biggest opportunities in DeFi are a combination of hitting the assets that aren't EVM native or don't have a Solana token, Bitcoin, Ripple, Cardano, Doge, etc. And in addition to that, a lot of the RWAs that are coming on chain. And that's going to require a number of updates to some of the different DeFi protocols. So if I were to actually answer your question on what I think might lose some ground and what might gain some ground in the area of lending, in which we specialize in, I think that in the long run, isolated modular designs are going to win out over pool-based models, cycles, etc., that are best handled in an isolated framework. Not to mention, in my opinion, the superiority from a risk management and contagion perspective.
So Alex Zinder, I'm a chief product officer at Blockdaemon. Prior to that, I was with Ledger for 3-4 years, and before that, I was a capital markets guy with NASDAQ, mostly on the technology side. I'm going to take a capital markets view to your question, because I think it's what I know well, and I think there's actually a good fit there. What stays? I think it's a two-sided problem, right? You need a supply and demand equation that works fundamentally, right? So on the demand side, I think obviously retail adoption will continue to push. So you'll have your existing players like crypto.com and Coinbase, then obviously a lot of the traditional players that have the eyeballs today, right? Your E-Trades, your Robinhoods, your Schwabs, your Fidelities of the world that have a very large captive audience with a lot of wealth advisory type of services. And on the product side, what you need to deliver to that audience on the supply is yield opportunities, right? And there's a wide range of these, and I think they'll continue to evolve. Anything from low risk, full on staking capabilities, right? Direct staking solutions generating yield, to lend borrow models,
Awesome.
to kind of more
Kendall, and
more
then
nuanced
risk
and
special and
higher
kick off, guys.
risk trading strategies on dexes, your cash and carry trades, other potential long strategies. All of this is going to start to get more and more productized as we keep going, right? We'll start to fit into different risk metrics, and will be delivered to the right audiences, based on certain classifications. These models don't exist today, right? Frankly, in DeFi.
Yeah, thanks, guys. I'm Kendall from Proximity. So what we do is we support teams building cross-chain applications, agents, and more using primarily near intents as infrastructure. So I agree a lot with what Alex and Arif said there. I think that the biggest thing that's changing is we're seeing the barriers to getting on, I think, happening more through you have a ton of fintechs and even banks that are going to start adding in kind of effectively crypto rails, and they won't even look like crypto aspect of it, but an easy way to get access. I mean, what hopefully will happen is extra products that exist on chain really start to prepare a product that's specifically kind of for, seeing some interesting experiments at the institutional side. USD AI is a really good example here. Daylight's anyone that's kind of coming up that are, really just early experiments in that. As we finally collapse this barrier between, off-chain and on-chain, thanks to, things like Genius Bill and, knock on wood, maybe market structure, I think that's where we're going to see, both more experimentation and adoption of both the retail and kind of institutional side with regard to DeFi.
So I can go next. Yeah, so a short intro. So I'm building right now EncryptTrade. Before this, I was, at Goldman Sachs. I was working on the AI side over there for 2 years. I've worked with teams like the data availability layer, and I started doing EncryptTrade 3 years ago. And to answer your question, Andy, I think everyone else has covered most of the points, but I still think there are certain buckets that you can put the real utility of crypto or blockchain. Obviously, there are stable coins, which I think are the most valuable thing, the ability to transfer assets cross chain or cross continent in a matter of seconds is still huge. And I think it's one of the biggest use cases. And there are other use cases people love to one of the major use cases where people use blockchains or crypto is speculation. I think speculation is a very big use case, and we are seeing this with all kinds of markets that are created. Earlier it was meme coins from the retail side, right now it's prediction markets, and we see institutional interest as well coming to the prediction markets. And these kind of things will evolve with time. There will be big more innovative kind of markets that will be created, and I think with time people will get exposure to them. like every trading terminal, they need to constantly evolve by integrating all these markets that are already existing or like getting innovated. And when you have that front end, which basically has all those things integrated, like as you see, like right now, your wallet is that front end. So most of the wallets are integrating prediction markets and already have stable coins in them. So I think that is an ever evolving application, which has the biggest moat in my take. Like obviously, like centralized exchanges are at that place, but and if you see on-chain finance, like wallets have a very big moat in that scenario because they are like an entry point over there to the user. And whenever user has assets over there, then they can basically send it from there as well. And if the applications are accessible from the wallet, it basically doesn't make the user leave that application. And the wallets are moving towards a like a neo banking application or a super app kind of a thing, which allows the users to use everything from inside. The majority of the DeFi primitives from there, and like the yield primitives, the trading primitives, and all these kind of things that are there. So in my take, like wallet is one of those applications which has achieved that role right now.
Yep.
Yeah.
Definitely. Guys, we wanted to frame this conversation under the guise of this idea of neo-finance, which is really this convergence point between DeFi and legacy finance. It's not fintech. It's not traditional finance. It's not DeFi as we know it today. It's not holding your seed phrase. It's not necessarily using a ledger and clicking to sign off every transaction. It's really just usually mobile or institutional-based user experience with something akin to what you're used to from a brokerage or a mobile app. It's using DeFi underneath. Alex, you mentioned a lot of experience in capital markets, and we know that a lot of these assets are coming on chain now through your work with Blockdaemon. You guys are providing APIs and a ton of different tooling for that to happen. When it comes to this era of neo finance, as kind of like this next big step for the on-chain industry, for the blockchain industry, covering tokenization, stable coins, etc. Kendall covered quite a few of the other interesting private credit vehicles, USDAI and Daylight, which are really focused on exogenous yields, not this kind of hyper looping of CE DeFi that we saw with BlockFi and Celsius and Nexo. Really just a more sustainable path forward with the kind of institutional global TWAP on majors, as well as their desire to get into this asset class. Alex, kind of with that context in mind, what is this idea of neo finance as the evolution of DeFi mean to you? How do you think about this next set of applications and user experiences, especially as it pertains to intents and the work that you guys are doing at Blockdaemon?
Yeah, that's a great question. And I think, the foundational elements are going to shift in the DeFi ecosystem to be able to support this momentum and the adoption by the traditional financial sector. So for this kind of neo-finance concept to really exist and mature and continue to evolve, there's three foundational pillars. They're quite boring, but they're critical, right? You need reliability, you need scalability, and you need security. And without those three things, financial services do not function. They will not work. And scalability is actually also a critical component, because the audience that we're talking about here, right? Like if you think about all the users of something like E-Trade, right, or the Morgan Stanley accounts that are out there, it's very, very different than the current footprint of what exists in DeFi today. So the scalability aspect is going to be critical. So those are the boring pieces. And then also regulation is very important there, but it's not something that we can really control, right? That is just happening, throughout the maturity of the industry. There's a lot of advocacy that's happening in that regard, also an important component, but I'm kind of taking more of a technical, controllable aspect of it. So it's really up to us to build systems in a way where they're reliable, secure, predictable, and scalable. And there is an exciting component to this as well from a institutional perspective, from the kind of traditional finance perspective. There is a time to market aspect, right? So it's a very steep learning curve. These user interfaces and these capabilities are quite expensive and quite time consuming to build and evolve and bring to that level of maturity. So we're actually working on building some quite exciting interfaces that are completely pluggable into the existing financial services and financial applications that you see today. and are directly working with some of these players to embed that capability directly into their applications. But again, that comes with a certain threshold, right? Like these have to be audited, right? They have to be secure. They have to be reviewed by their security teams, tested at scale. So it's quite a resource intensive and a time intensive process that we're looking to expedite and shorten that time to market period from an adoption perspective. It is really an exciting time and an exciting catalyst for this, and we're seeing a tremendous uptick in usage and actually and integration from the larger organizations in this space, and it will bring outsized inflows into the crypto ecosystem, and this is where also a lot of the liquidity aspects are going to need to be tested on chain to kind of look at that, the current behavior of some of these protocols and systems, and what happens to that at a certain level of scale. Because as we know, right, outside of staking, well, even with staking sometimes, right, what we've seen with Ethereum and the wait times to kind of deposit and withdraw, the liquidity constraints and some of the liquidity constraints of most of the DeFi strategies, that is going to come under a lot of pressure. Which simply means that there's going to be also symmetrical demand on the supply side, right? So more and more supply and the inflow of capital to be able to accommodate the retail needs, which just simply means that the infrastructure has to be robust on both sides of the equation to be able to support this.
Yeah, appreciate that perspective, because we're seeing this happen more and more. Like for so long, it was the institutions are coming. Well, they're here and they're integrating, right? And so it's validating in some sense that it means some of the foundational pillars, the reliability, the security, we are there. But as far as tactically integrating these two systems, the devil's in the details as we get deeper and deeper into these integrations. And so, Kendall, you mentioned private credit. That's one of the asset classes that coming on board. We saw the New York Stock Exchange announce like they want to tokenize. They want to go 24/7 trading, bringing U.S. equity markets. And then, we also see, several more asset classes coming on chain. When the New York Stock Exchange made that announcement, it was very contentious on, crypto Twitter. People were saying, how is this beneficial, right? If they come on, well, that's not really, doing that much for some of the crypto native assets, right? The Bitcoins and the ETHs. They're just bringing equities on chain. It's like, they're improving their own internal efficiency. If they do it on a permission chain, what does that really benefit this crypto ecosystem we've built for so long? On the other hand, you've got Larry Fink in Davos talking about how it's important that all of this exists on one composable super ledger. Hypothetically, he's talking about, ETH or another, predominant L1. How should we think about these institutions integrating into our system? How important is it that they use an open permissionless chain? Is it crucial that it all exists on one chain? And would you guys, Kendall, maybe we'll start with you. Would you say this is them coming on chain? Is this a net positive for the entire industry, or does this just benefit, the efficiency of the New York Stock Exchange accounting layer?
Yeah, it's a great question. I mean, I think the dirty secret about like all of the stuff that a lot of us have been building for a very long time now is that it's pretty much all infrastructure. There's very few like real assets. I mean, there's a few, Bitcoin's amazing, Zcash, some of the layer ones, and like and increasingly, assets like Aave that, support some of the infrastructure, right? But like primarily, we don't actually have that many high quality assets that have come on chain. And I think what's really exciting is like now that is starting to happen. And it's true, most of it comes with caveats. Like we're not actually anywhere close to, I think, the future we all still envision here. But at the very least, we do now have serious players who are responsible for issuing serious assets, and also serious regulators that are taking this infrastructure we built very seriously. They do believe it's like at least close to ready for prime time, or components of it are. And so we're now able to like go up this quality ladder of assets. And I think that's ultimately what's going to like make neo finance kind of live or die, is like, is it actually being used for high quality finance, right? So that's one aspect to it. That's why like I think it is very bright sign that this is happening. I think the permissionless permission piece is definitely very important, right? I mean, I think the positive sign is some of the most serious players are pointing to like the value and benefits of like a permissionless underlying system. I don't have a whole lot of takes on like the permission aspect. I kind of thought we were sort of past that. I guess, we'll never be fully past that. But at the very least, I think what is interesting. You have something like Canton, which is like more on the permission side. But there's actually already, I mean, in this, even on like the intent side, you're seeing a lot of like bridges being built between permissioned and permissionless. And, I think the devil will be in the details of like, what does it mean? What is required to move from a permissioned to a permissionless system and vice versa? I mean, we've seen a few early experiments with this with like, Ondo launched a permissioned version of like fork of Compound that like you had to be whitelisted in order to borrow, but you didn't have to be whitelisted in order to lend, which is really kind of an interesting hybrid. And I mean, this is where I think, getting more clarity, like no pun intended, from some of the regulators is going to make a lot of reasoning about a lot of this sort of trade-offs much easier. Right now we are kind of still in this gray area. But, I think the signs point to like, we're going to be able to sort out a lot of this madness. And, again, like the TLDR from everything I just said is like, we need high quality assets and we need to be able to use all this great infrastructure we built, which is pretty much all it is, for high quality assets, both to create them, to lend against them, to make them tradable, all these different aspects.
I think these are great points. If I can, I would love to jump in for one minute, because I think there's an important distinction here that can drive the trajectory of the conversation further. I love the permissionless discussion, and it's a little bit kind of polarizing in some ways, but fundamentally, the way we look at it, and for me for a while now, it's not a black and white type of thing, right? I think permissionless capability and kind of where that permission to permissionless spectrum sits is really a factor of scale at the end of the day, right? So you can have a permissioned ledger, but when you reach, billions of individual users, how permissioned is that really? Like, what are the controls that you're going to have, and how does that scale? Or you can have a permissionless ledger like Ethereum, right? But then, you can today set up a protocol in a vault with a whitelist, of 10 participants, right? And isolate that protocol and capability to a very constrained user base, right? And basically run a permission model on a permissionless ledger. I think the important aspect of it is really scalability, right? Like, how many participants in the actual financial services do you want to support on an individual basis without intermediaries, right? Because the current financial system is hub and spoke, right? Like, we solved the scalability problem by introducing intermediaries into the equation, but having direct access to something is definitely a scalability challenge. And then it has to be composable, right? That's the next piece of this, right? If you have permissioned and permissionless networks that are composable, right, that you can actually move assets from one to the other under certain circumstances in different settings, that makes for a much smoother user experience, but also a much wider ecosystem. I think that'll be the value proposition of moving things on chain versus keeping them in the legacy infrastructure.
Royal or Rishabh, anything to add there?
Yep.
Go ahead.
Oh, sorry. I was just adding that. I also think that maybe the privacy aspect is also very important over here. I think a lot of infrastructure right now is like transparent, and obviously, like, I don't think like when institutions are coming over there, like lack of privacy is going to be support them. So we do need a proper layer on top of existing blockchains, or maybe like right now new L1s are coming which are fully private by nature. Maybe those are the kind of solution which institutions are looking, and there are solutions like Canton Network, Aztec, that are working on that direction. But maybe like we are providing such a kind of a solution where maybe existing blockchains can have privacy, like because most of the liquidity is there in the existing blockchains like Solana and Ethereum. So I definitely think that is also a very big missing piece for solving the whole problem of that.
Halliday is unified crypto payments. Give your users more wherever they are. Go to halliday.xyz to never write a smart contract again.
Looking for yield that stands out? infiniFi gives you just that. Deposit stablecoins and earn far more than the current savings rate. infiniFi is a battle-tested, reliable DeFi platform that is ready to go. Head to infinifi.xyz.
YEET is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Yeah, I think I view this permissioned versus permissionless question like with the framing of the Hegelian dialectic. Like originally there's this thesis of like centralized permissioned finance. That's TradFi, right? And then Bitcoin comes out. this cypherpunk antithesis of the TradFi model, where it's truly trustless, permissionless, etc. And what we're seeing right now, I think a lot of your framing around the neo finance is what you're seeing, like a synthesis of the two, right? So what I think that actually looks like, this synthesis, is using a permissionless layer as the base, and then you can add permissioned modules, networks, protocols, etc., on top of the base permissionless layer. So the whole design space is not scale free. I believe it was Alex that was talking a lot about scalability, and I think it's important to realize that the design for different levels of scale changes, right? You know, at a base layer, you do want permissionless because that's how you access the entire world. You know, that's part of the appeal of crypto, is that you can get billions of users on board. Whereas, you know, in a permissioned model that doesn't really quite scale as well, you're inevitably going to have a ton of fraud and bots that you're going to have to fight in this, you know, permissioned silo. Whereas like in a permissionless base, you can build on top of that, you know, your different walled gardens and the tempos of the world, you know, permissioned forks of open protocols. And even in the context of, you know, you can have a base protocol, like a DeFi protocol on top of a permissionless layer that has like permissioned vaults on top of it. So the underlying protocol itself could be permissionless, but then you could have a specific vault that requires whitelisting, or that people follow certain parameters. So I think that there's going to be this synthesis of permissionless cypherpunk crypto and permissioned regulated finance that are going to be, you know, kind of joining together to create a new experience. And there's going to be a whole spectrum of apps for different use cases. You will have the cypherpunk use cases that are completely permissionless and decentralized. And then you'll have the completely permissioned ones, like all the way up to like CBDC. Those will exist in some parts of the world. But I think a lot of finance in the future is going to be somewhere in the middle. So yeah, I think that's the exciting opportunity here, is to, you know, help shape like everything in the middle.
I think that's where our focus is too. I mean, we've swung so far to the DeFi side, stayed very far away from the kind of CBDC side, if you're going to take it to its fullest extent of the extreme. But it's really somewhere probably closer to the DeFi side than closer to the CBDC side in the middle, but over there somewhere, which actually brings me up to a interesting question for you, Kendall. Through the chain abstraction work that you guys are doing at Proximity Labs, how much execution detail can you actually hide, and how much abstraction can we actually build into these applications? Thinking about this thing from the context of the spectrum that Royals brought up, you know, how much control do users really want? How much execution detail can you hide, and how much abstractions can you do to make this neo finance vision come to life, to make it easier than just, you know, clicking on all of the DeFi applications, but also not having a full custodial kind of interface? Where do we kind of find the middle? How do you think about this?
Yeah, it's a great question. I mean, I think it definitely depends. Like when you're talking about like the complexity you can hide, it definitely depends like which layer of the stack you're sort of talking about. So I think near intense is like first big success when it comes to like simplifying the UX across chains, came mainly from that specific piece, cross chains, right? Like if you're a user and you have assets on one chain and you want to either use an application on another chain or even just acquire assets on another chain, that was kind of fraught with you having to use like multiple different systems and applications in order to accomplish that. And also you had to like learn how different chains work. So you had to think about like whether you have gas on that chain. You had to think about like, do you have the right wallet for that chain? There was just a lot of like added kind of mental load for these users that like basically reduced a lot of like cross-chain activity. The near intense team, which I cannot take credit for because this is all them and Alex and his team, they did an amazing job actually building this layer of abstraction for most users where, you know, using near intense is a simple example, which is like, okay, I have Sol, I want to buy Hype, and you just go there and you just do it. And, you know, you can use your Solana wallet or your Hype wallet, or I mean, they have like any number of kind of options that are available there, and they abstract all the complexity of needing to make sure you have the right gas tokens on the right chains, and needing to think about like how different these networks are. And I mean, even better examples probably like Zcash to XRP or something, like couldn't be more different and how they're constructed, right? And so that's like the first step, right? Is like for people who are already using crypto, who are already in one chain, have one wallet. But you can, of course, like take that a step further too. Like on the one side, you can abstract building for developers, where if you wanted to build this kind of either chain agnostic or even multi-chain, which I think are different type of application, then that involved having to, I mean, as the other guys in this call, Blockdaemon, et cetera, know all too well, there's a lot of work that has to go into that. Connecting the RPCs, like learning how the chains work, learning different smart contract languages, different virtual machines. And I think what's really cool about, a lot of this chain abstraction tech that is now somewhat mature is that you really can just like learn one set of APIs of one system, and then you can get a lot of interaction for free. So that's on like the developer side. And then I think, finally on the user side, like we're going to see basically, my thesis still is like, everyone's kind of banking app is going to be a route to them being on chain. And I think that like those banking apps and those fintechs are going to be the ones who are going to be adopting a lot of this chain abstraction tech on behalf of their users in order to basically completely remove that from the experience entirely. They may even hide the fact, like they might have, Revolut will probably have Revolut USD, whatever, like their stable coin. And they probably won't even call it that. They'll just call it USD, right? As far as like the user experience goes. And then that Revolut user might want to pay someone on like Venmo or like Robinhood, and Robinhood will have Robinhood USD. And in the background, what will happen is there'll be like a swap from like Revolut USD to Robinhood USD. But the user will just be like, oh, my friend has Robinhood, I have Revolut, I sent them a transfer, and everything worked out, right? I think that's kind of like where we're going to go. And like all of the kind of, block cross chain, like cross asset, different DeFi protocol, all that stuff will be abstracted away. And it's just basically just a lot of work by, teams like Alex and Near Intense and Blockdaemon and a lot of the people on this call to, roll up their sleeves and and build a lot of infrastructure. But, after many years of letting this all bake, we're getting really, really close.
Not your keys, not your coins. From the team that pioneered cold storage, Trezor has just released its new wallet. Guys, if you are still using hot wallets in 2025, 2026, you are missing the entire point. Secure your coins. Get a Trezor at trezor.io.
Hibachi is fast and private perps trading, secured by ZK with Celestia underneath. Go to hibachi.xyz to start trading today.
Trade on anything: economics, weather, sports, crypto, and more. All on Kalshi.com, 24/7 for the world's biggest prediction market.
Yeah. I think it's really exciting to see this play out because, this is something that we interacted with at the base layer. And I really like Royal Fool's, the way in which he's describing kind of the base layer here. We can all interact with it. Kendall, you're talking about abstracting some complexity. Before you guys joined, it was like, okay, we've got this dimension of choice and simplicity. On the one hand, we can give all the users all the choices in the world. It's going to be very complicated. On the other side, we can be a very simple, but we don't really pass along all those choices. And so I'm just curious, as you guys are thinking about risk management here, like, because we did see the DeFi, 2021, 2022, a lot of people went to jail because the money disappeared. It all ended up in Do Kwon's Terra Luna anchor farm paying 10%. That was real easy. There wasn't much complexity about like, what the yield was or where the choices were. It was like, you get 10%. That's it, right? And if there's a financial super app or a neobank that's like, hey, here you can earn 6.5%. That's it. There's no more choices or complexity baked into it. How do we manage risk on in that sort of paradigm? And if you guys have insights into how the Revoluts or the Venmos or, how are these guys thinking about risk management from this perspective? Open question. Feel free. Anyone to jump in.
That's a great question. I think there's also a parallel to the previous question that Kendall did a really great job kind of going through. To me, it's really a matter of financial incentives and where do you draw the line from ease of use, right? From abstractions of the complexity from the user to the service provider. And there's risk baked into that as well, right? So if I'm just going long on Bitcoin, right, and holding it in my own ledger, my own ledger wallet, right, with self-custody, that's great, right? That's a very easy model. I know the risk, right? The risk is all with me as an end user, and on the other side of me is a public network, right? However, if I want to log into my neobank account, to my Revolut account, and to your point, deposit and get 8% returns, they're pooling capital, right? They have different strategies that they're leveraging behind the scenes. They have liquidity concerns and constraints that they need to manage, right? They have millions of users that they're doing this for. The risk is with the provider. Now the question is, how much are they charging the user to manage that risk, right? To provide that service, to manage that capital. And there it's really just an economics model. And, as long as there's a very varied user base with different risk acceptance and, different levels of being informed, you're going to have different models that fit that. The interesting thing for us, though, this is where I love being on the infrastructure side and really building the tooling around this, that from our perspective, it doesn't really matter that much, right? Even if you look at the intent model and kind of the solver ecosystem, that ease of use that's provided by the solvers, it's still the solvers are still entities, right? They still need to manage the capital and the liquidity, right? They still need to interact with multiple protocols to manage their own treasury after they've serviced the intents that they're servicing. It still needs to scale. So they will still need the RPC nodes, the connectivity, the wallet management capability, the bridging to manage their operations effectively, to provide that service to the user. And it's just a matter of like, where does it sit? Like, how much are we abstracting away for the user? How big of a service is the solver providing, and what tools does the solver need to be able to function effectively at scale?
Yeah, if I can jump in on just you mentioned Luna and in general, like the risk of, different yields in finance. I think that this has been a problem since, the beginning of money, right? How do you properly manage risk? And this is something that is in no way unique to crypto. There's always going to be people who are greedy and are picking up pennies in front of a steamroller. And at various scales, both at the crypto Luna scale and at like the global financial system scale, as you get more centralization and everyone's piling into the same yield, that concentration creates a lot more risk. So what's really important to ensure that you have a robust financial system from like a risk management perspective is truly free markets and the ability for those free markets to function when something fails and something else to come back in its stead. And the idea being that you have different sources of yield that hopefully are isolated from each other and are generally uncorrelated to the downside. And that when there is a huge black swan event, that the contagion from that is minimal. So I'm sure we're going to have more credit blowups. We're going to, we had 1010 and Stream Finance recently, and DeFi as a microcosm of the Terra Luna situation. That's going to happen going forward. But what's important, especially in crypto, is that you have systems that are robust and anti-fragile enough to survive those type of events that will inevitably happen.
Kendall, anything to add there from the perspective of just kind of understanding where this is all heading?
No, I mean, I think that summed it up, quite well. Yeah, ultimately, I think this is where each of like the kind of application developers is going to make a choice based on whatever user group they're targeting. Is like, there's going to be a lot of these applications that'll appeal to different people. More sophisticated people want more flexibility. Less sophisticated, people might just want like set and forget it. The big risk of set and forget it is you don't know what you're setting and forgetting, and it could blow up, right? And I mean, yeah, it's going to be a mess. I mean, definitely our focus is on just giving the tools to the developers to, navigate all these choices. I think like one thing that can be really nice in, the spirit of what RF said about like decentralization is like, if we can create a market where there are going to be a lot of choices and then we make it really easy for developers to provide those choices to their users, then we at least like create the landscape in which, you can have a lot of like, hopefully good choices. Definitely there'll be some bad choices, but hopefully a lot of like good choices and, a lot of kind of customization based on, user needs. And, if there's anything, if we're going to throw AI in here, it's like, I think AI is making it a lot easier for people to evaluate a broad landscape of complex choices and decisions, sometimes poorly, but in a lot of times really well. And so, still hopeful that there's a future where like, yeah, we see blowups, but blowups are a lot more contained and, we make the landscape as competitive as it can be.
Love it.
I think we can't forget about liquidity in that context. Another very important aspect and something to think about, right? Like we're creating the tools and the capabilities to drastically increase the number of options and products that are out there today available to the user. The challenge, of course, is each one of these products needs to have certain liquidity requirements to actually be viable and manage risk in that regard. And I think that needs to be a conscious thing, right? Because to support a much wider surface area of available products, you need to extend your capital profile and capital allocations. So the floodgates really do need to open on both sides. And this is really how we think about the problem. And we're just as deliberate about building infrastructure for inflows of capital from the large institutional places to be able to actually properly create the liquidity capabilities required for this growth in asset profiles, as we are in building the infrastructure to bring the retail demand and in some cases also the institutional demand that is going to be buying and investing in these products.
Gentlemen, thank you for joining us on the Neo Finance special for the Intense Day. It's been a great conversation. I think we can all agree that this space is changing direction with the influence of legacy finance coming on chain and really trying to tokenize as many assets as possible and bring more sustainable, reliable yields on chain, doing it in a private, compliant manner, operating somewhere in that gray area, in that middle ground, through each of the work that you guys are doing. Guys, thank you for being here with us today, and hope you guys have a great rest of your day. And shout out to the Intense Day special.
Guys, thanks everyone.
Thanks for having us.
You guys.
Cheers.
Bye.
See you guys.